Hey guys, James here with Waterford Business Solutions, and I wanted to talk about today kind of a brief overview of your chart of accounts or general ledger and what it does in QuickBooks, how it helps you, everything like that. Now, again, this is a brief overview. This isn't going to be talking about setting it up. I'm going to talk about setting it up in a different video or going into detail of what each and every little thing is. So please keep that in mind. If you need more help, if you need more information, something like that, please reach out to an accountant, please reach out to a bookkeeper, or feel free to give us a call, shoot us an email, visit our website, and we'll be happy to help you there. With this kind of video, again, it's an overview. It's going to tell you what kind of goes in an account, where it's going to show up in QuickBooks, and how it's going to affect your books and make up your books in QuickBooks. So I'm going to start up top here with the bank account. The bank account, you can have multiple of them. Bank account, savings account, money market accounts, any account that you're spending money in and spending money out of or bringing money into other than a credit card account. Because a credit card account is something different, which we'll get to in a few minutes. So you'll see this bank account up here. I've only got one in this account, but what happens with this bank account is at the end of the month when we go to your balance sheet, what it's going to show us is how much is left at the end of the month, removing out any checks, removing out anything that you have paid out but hasn't actually cleared the bank, and tell you how much should be in that bank account at the end of the month as an asset to the company. However, at the same time, whenever you're having these expenses, you go out and you buy new tools, or you're doing the payroll or anything like that, those transactions are going through this bank account to go into these accounts down here for income or expenses, anything like that. So this bank account is actually the key thing in all of QuickBooks where everything's going. But the bank account itself, other than tracing the transactions to it, is going to only show up on your balance sheet as an asset for what is left in it. Moving on down the page here, we've got accounts receivable. This accounts receivable, this is going to be any jobs, any invoices, anything like that that you have done, but you haven't received payment. So when you open up your balance sheet, again, this is going to be up top on the assets area. And this is going to basically go over, we've done this job, but we're waiting on payment for it. Again, it's an asset. Overall, your accounts receivable should steadily go down, but as you do new jobs, you're going to have new payments. So generally, you're going to have a balance there unless you require payment before you begin work or before you even leave the job site. So you're almost always going to have a balance in accounts receivable that is acting as an asset for the company. Then you're going to have other current assets. So other current assets, that's going to be something like inventory. If you have inventory, say you're a plumbing company and you've got PVC pipe and you've got glue and everything like that, or you've got toilets or sinks or something like that. Now you have inventory that you're selling. So while that is sitting in your possession, you've already spent the money on it, but it's an asset that the company owns until you sell it off. So that's what goes up in inventory. Then you have other things like uncategorized assets. QuickBooks requires you to have an uncategorized asset, uncategorized liability, uncategorized income, and uncategorized expense. Please don't use those. Personally, for me, it's a personal thing, but a lot of accountants don't like that because uncategorized, it's not giving us any information. It's just kind of giving us an overview saying, okay, we spent this money. What did that money go to? Unfortunately, we can't delete these, but they're always here. So all I can say is just avoid using these if at all possible. Undeposited funds is going to be just that. When you are taking payment of everything, when you take it by check, when you take it by credit card, whatever, it doesn't immediately go into your bank account. It's going to have some processing time, whether it be you take it at 8 a.m. in the morning and you don't take it to the bank until 4 p.m. the afternoon. It's not immediately deposited unless you're doing remote deposit. Some people do that. So what undeposited funds is acting as is it's a holding bin for checks or cash or credit cards that the payment is in transit to your bank account. So at the end of the month, again, showing up on your balance sheet because anything above this equity line here, this is all balance sheet things, and we'll have a different video talking about the balance sheet and what it tells us and everything like that. But undeposited funds is going to show up there on a monthly basis as an asset of you have this much money waiting to go into the bank account. Now we have several other assets that I don't have in here, so I'm just going to go through those real quick. I'm going to go with the other assets real quick. So you'll see things, other current assets I want to go with here. So you'll see other things like here. So you might give a loan to employees or something. Technically the employee is going to pay you back, and that's going to be an asset that eventually you're going to get back. We would track that as an asset. You've got investments. Maybe you make an investment in another company and you're making dividends in it, something like that. You've got prepaid expenses. So maybe you pay your insurance. If you're on accrual accounting here, please keep in mind there that assets, especially prepaid assets, is only going to affect accrual accounting. But prepaid expenses here, if you pay your insurance every 6 months, so you pay insurance on January 1st, and that payment is good for January, February, March, April, May, and June. Over time, you're going to be depleting that asset. But we don't want to recognize that expense all at once because we're slowly depleting that asset. Again, that'll be something that I'll probably go into in another video. Other types of assets so we have the other current assets, then we have fixed assets. So fixed assets is going to be like big pieces of equipment. Maybe a vehicle that you own, maybe a copier or equipment or computers that are at the office, big tools. If you're a mechanic shop or if you're an HVAC company, you might need a sheet metal bender, something like that to be able to do your job. So that's what we would want to be tracking in here. Other things that we have is like land. If you have a building or if you have land, then that's an asset for the company if the company actually owns that. Again, all of these assets are going to show up on your balance sheet. Another type of asset that we don't hear a lot about is going to be your amortization and your depreciation. So amortization is going to be affected by intangible assets. So an intangible asset is going to be a trademark, a copyright, something like that. So you came up with this new machine or this new method of doing this, and you patented it with the U.S. Patent Office. Well, that's an asset that the company owns. Or you have a logo and you've trademarked that logo or trademarked that name. Technically, that's an asset because someone could really want that and want to buy it from you. Obviously, the value of that is dependent, and that's really where working with an accountant, working with a bookkeeper comes in handy. Depreciation is a little bit easier to understand. When you buy a vehicle, vehicles are the best example of this, they're going to depreciate slowly over time. Generally about, after the first year, about 15% to 16% a year is what that vehicle depreciates as. So you're going to just have to kind of watch out for that and keep up with that, and that's what that depreciation is. Technically, until you expense out that depreciation, it is an asset, and generally you expense out the depreciation at the end of the year. Getting out of assets, I'm going to go ahead and move on down to your liabilities. Liabilities is going to start with accounts payable. These are going to be bills that you have received but haven't made payment on yet. So you get a bill from a distributor and you don't have to make payment on it for a month. Well, technically you still owe the money, so it's a liability that the company has, but you haven't paid it yet. So it's going to go into accounts payable, and it's not going to show up on your profit and loss statement or anything like that. It's just going to show up on your balance sheet as a liability that is payable in future. As we continue on down here, then we have other liabilities. Liabilities, just like assets, it's different for each and every business, and that's why talking with an accountant, talking with the bookkeeper is so important, to make sure that you're setting up all this stuff correctly and making sure that you're tracking everything you need to. So here we'll see Department of Revenue payable as a liability. Sales tax, that's a liability that you have to pay off over time. Other than just sales tax, you also have payroll tax. If you're running payroll, you've got to pay those payroll taxes over time. So something to always keep in mind with. Other liabilities that you can have. So we got your income tax payable. So maybe you work with an accountant and we say, okay, we know that this quarter we need to be prepared to spend this much in income tax, so on and so forth. So we kind of have to look out for that there just to kind of keep up with everything. We can have lines of credit that are out that they're short-term liabilities, something like that you've got to pay within 12 months. You can have tips that you need to pay out. You could have just different things. Again, talk with an accountant, talk with the bookkeeper, because there's so many different things. We also can have long-term liabilities. So long-term liabilities, that's going to be like a long-term loan. Long-term liabilities is anything over 12 months that's going to be on your books. So loans from the bank, loans from shareholders, stuff like that. Then we're going to come down here to equity. So equity is going to be what you as the owner kind of have in the business. So part of that could be the opening balance equity. If you don't have anything in the books when you start out, well, when you start the books and the business is already running, you're going to have some opening balance equity in it. The other thing you can have is owner's investment. So you as an owner, it's not going to be unusual that you have to put in some money into the account. Or you might have shareholders that put in some money, or a business partner that comes in. So we want to track the equity that each person has at the same time. Then as you have personal expenses and stuff, that's going to take away your equity. So we want to kind of track that too, because while you're spending it out of the bank account, it's not a business expense. You're taking away your equity that you have in the business. Now, always, always, always try to keep your business and personal expenses separate, because you don't want to have your business and personal expenses combined. It just creates a fiasco with doing the bookkeeping, a fiasco with doing the taxes, and it can get you in trouble too if you're not tracking everything correctly. So that's kind of the balance sheet side. And again, I'll go into more detail in a different video about what the balance sheet is, what it tells us, everything like that. Coming on down here, we're going to end up into our income, cost of goods sold, and expenses. So everything down here, this is going to be on our profit and loss. Income is going to be just that, any money that you bring in. So you have different areas where you can bring in money. Different businesses do different things. So maybe for an HVAC company, we want to track our residential income versus our commercial income, or our installs versus our service. For an electrician company, we might want to track our new builds versus our older stuff, or just renovation stuff. For a carpet cleaner, we might want to track our carpet cleaning versus our upholstery cleaning versus our tile cleaning, so on and so forth. So there's multiple different things that we can track. Ultimately, income can be just one account. All of your income can go to one account. I like to break it out and say, okay, these are the different kind of divisions, the different things that we do. So we want to track each of these kind of separately. So that's what I like to do personally. So you'll see in mine that we just have several different things here. Once again, you're going to see uncategorized income. It has to be there. We can't get rid of it. Down below, you're going to see cost of goods sold. I'm going to do a different video about cost of goods sold, because cost of goods sold gets confused a lot. But the basic thing of cost of goods sold is going to be any expense that you have that is job specific. Look out for another video that's going to go more into detail there. Down below, we're going to have our expenses. Expenses, these are going to be kind of custom tailored to you. Each business kind of has its own expenses. You might have office supplies that you're buying. You might have bank charges. A lot of banks, they'll charge you fees to have stuff. Always watch those fees, just as a quick side note, because you don't want to be overpaying them. So you might have office supplies. You might have legal services or professional services with a bookkeeper or a lawyer or someone that you kind of just keep on retainer to help you out there. You might have payroll taxes or payroll. So if you're running payroll, if it's not just you, you're running payroll. So you're going to have salary expenses, payroll tax expenses, everything like that. You might have repairs and maintenance, taxes. You always have taxes, whether it be for permits, whatever, but you're always going to have taxes. You might have travel, depending on if you travel for the business or go to conventions. So that's what these expenses are. We really want to understand what type of expenses you have as a business to determine what is best to track there for you. because we don't want to nitpick and have a category for Circle K or for every single gas station you go to, just being a little more broad there, or every single vendor you go to. We want to understand what you do main expense wise to create this. We don't want to have a ton of chart of accounts or a ton of different accounts here in our chart of accounts because it can get overwhelming. My general rule of thumb is a good chart of accounts is going to be specific enough to understand what's going on in the business, but not confusing to you. That can be anywhere from maybe generally about on the low end 30 to 40 accounts to I really don't recommend much over 120 unless you've got a lot of assets, a lot of vehicles that the company owns, something like that. Between income and expenses, you can generally track all of that with 50 or less accounts. Really where your accounts start ballooning is going to be if you've got a bunch of liabilities out, a bunch of assets, stuff like that. As always, guys, this is just an overview just to kind of help you out. I do really recommend calling, talking, working with an accountant, working with a bookkeeper, someone who knows you, someone who knows your industry to figure out what works best for you. Don't go into this blind. If you were not trained to do this, work with someone who does know what they're doing. It's going to help you out in the long run. Give me a call, shoot us an email, something like that, and someone here will be happy to help you and explain everything to you. Y'all have a wonderful rest of your day.